Welcome to Iron Financial, where we systematically test the structural integrity of your investments so you can forge a stronger portfolio and cut right through this market weakness. I am your lead analyst, and my job today, as always, is to tear down the balance sheet, inspect the revenue beams, and tell you if a company is built on bedrock or if it's just resting on sand. Right now, the broader market is flashing some serious warning signs. Inflation is continuing to squeeze wallets, household credit card debt is absolutely maxed out, and major, historically stable retailers are genuinely struggling just to get shoppers through the front doors. But then, we have Dollar Tree, ticker symbol DLTR. Today, we are putting their Q1 2026 results through a rigorous stress test, because we just watched this stock jump a massive 10.4% amidst that incredibly weak, broader retail environment. Now, for the market skeptics out there, I know exactly what you're thinking. You're looking past the shiny corporate paint job, you're asking the hard questions, and you want to know if the hype we are seeing here is real, or just a structural trap waiting to cave in on us. Is this recent surge built on a solid, unbreakable foundation, or are we just looking at multi-price hype? Well, hit that subscribe button to join the Iron Financial crew, and let's get our hands dirty and find out.
Here is our inspection blueprint for today's explainer. 1. The hook, looking at market weakness. 2. The drill down into revenue. 3. Forging margins on the bottom line. 4. We're going to hunt for cracks in the armor. 5. The blueprint of their strategic initiatives. And finally, 6. The verdict.
Let's move straight into phase 1 of our inspection, the hook, and exactly why this current, treacherous market environment demands our immediate attention.
Notice that massive 10.4% post-earnings stock pop. That pushed shares all the way up to around the $106 range immediately following their Q1 2026 results. Wall Street clearly saw something in the blueprints that they absolutely loved. But listen, a 10.4% jump in a single trading day is heavy lifting for literally any stock, let alone a legacy discount variety store. Think about the harsh reality of the retail environment right now. We are seeing major, heavyweight, big box chains issue incredibly cautious guidance because the consumer is just exhausted. So, when a dollar store suddenly rockets up double digits while the rest of the sector is flashing warning signs, you have to ask what kind of steel they are actually using in their foundation. We need to systematically answer whether that double-digit jump is built on a solid bedrock of a real operational turnaround, or if it's just a bunch of multi-price hype actively covering up foundational rot. To do that, we need to see the raw materials, and we need to track exactly where this money is coming from. Which brings us to section 2 of our blueprint, the drill down. Let's inspect the load-bearing top-line revenue numbers of Dollar Tree's Q1 financials.
Dollar Tree generated a massive $5.0 billion in net sales this quarter. That is a 7.2% year-over-year tonnage increase from the $4.63 billion they pulled in a year earlier. Comparable store net sales, meaning sales from stores that have been open for at least a year, moved up a very respectable 3.5%. But look at the bottom row. The real bedrock metric here is the adjusted earnings per share. Adjusted EPS, which is the actual tangible profit the company takes home per share after stripping out all the one-time accounting noise, didn't just grow. It literally exploded by 38.1% to 174. Now, if you're approaching this with a skeptic's eye, I totally get it. I'll admit, a 38% bottom line expansion is a reinforced concrete number. It easily beat analyst estimates of 155, but let's keep things in structural perspective here. A 3.5% comparable sales growth on a massive $5 billion revenue base isn't exactly screaming high-growth tech stock, right? It's steady, for sure, but is it enough to justify that massive double-digit stock rally we just looked at? We need to understand exactly how management engineered that massive EPS growth if the top-line sales only grew by 7.2%, because you don't get a 38% profit jump on 7% sales growth without pulling some serious, heavy-duty levers behind the scenes.
And that leads us perfectly into phase 3, forging margins. This is exactly where we find out how they engineered that bottom-line explosion despite all the macroeconomic pressures.
The undeniable proof of this engineering is right here in the GAAP operating margin. They successfully expanded their operating margin by 120 basis points versus Q1 of fiscal 2025, bringing it up to a highly solid 9.5%. Operating income itself jumped a massive 23% to $473.3 million. Okay, so let's put on our hard hats and inspect the actual line items doing the heavy lifting here. We can see gross profit improved to $1.82 billion, which pushed overall gross margins up to 36.8%. But what are the actual mechanics driving that specific efficiency? Well, the blueprints point directly to 3 things. First, higher mark-on. This means they are successfully pricing items higher right out of the gate when they initially put them on the shelf and consumers are paying it. Second, lower import freight costs, meaning it is getting significantly cheaper to move physical goods across the ocean right now. And third, lower shrink. Shrink is just retail speak for lost inventory, usually meaning less theft and fewer damaged goods. They are actively optimizing their supply chain logistics to cut costs at the most foundational level.
Breaking those forces down side by side really visualizes the structural battle happening right now. We have our margin tailwinds on the left, higher mark-on proves immense pricing power, lower freight shows serious supply chain stabilization, and lower shrink means fewer goods are walking out the back door unpurchased. These are the solid steel beams holding those profits up. But on the right side, any market skeptic will point out that we have some serious margin headwinds actively trying to corrode that progress. We're talking about higher tariff costs, higher markdowns to get rid of stale inventory, and rising general liability costs. And listen, general liability in a sprawling retail setting isn't just a rounding error on a spreadsheet. We are talking about severe, expensive things like slip-and-fall lawsuits, store safety issues, and workers' compensation claims. You absolutely cannot just ignore the rust building up on those beams. However, nobody is ignoring the rust. Right now, the tailwinds are overwhelmingly defeating those headwinds. That's exactly why adjusted selling, general, and administrative expenses only increased a measly 10 basis points as a percentage of total revenue. They are managing the corrosion effectively, keeping the overall structure entirely sound.
But let's not get too comfortable. Moving to Section 4, Cracks in the Armor. It's time to actively interrogate this data like a true skeptic and see if this foundation can actually survive a real, sustained stress test.
Here is the multi-million-dollar question that nobody ever wants to ask when a stock pops 10% in a single day. Is this real growth or just aggressive price hikes covering up a mass exodus of lost customers? We saw the 3.5% comparable store sales growth earlier, but when you dig into the footnotes, there is a massive, glaring structural flaw. Foot traffic, actual human beings walking through the physical front doors, declined by 1.0% in Q1. Now, foot traffic is the absolute lifeblood of a discount retail model. They survive on volume. If a dollar store isn't getting foot traffic, it means their core lower-income demographic is entirely tapped out by inflation. If your foundation relies on high volume and fewer people are actually shopping, what is holding this whole structure up?
Breaking down the Q1 sales drivers answers that question directly. Yes, traffic took a 1.0% hit. But the average ticket, meaning the actual amount of money each customer spends per visit, increased by 4.5%. That higher average ticket is doing all the heavy lifting and more than offsetting the traffic drop. But let's pause and think about that. They are actively bleeding individual customers but extracting more cash from the ones who actually stay? That strategy works in a strong economy for sure. But in a severe consumer slowdown, relying entirely on higher tickets while foot traffic steadily erodes is literally like removing a load-bearing wall and just praying the roof holds up. Management, however, views this as a calculated structural pivot. They are aggressively expanding their multi-price assortment. That means selling items for $3, $4, or $5 instead of just strictly adhering to the legacy 1.25 price point. So customers are buying slightly less often, but when they do come in, they are buying higher value items. The overall unit economics are actually getting significantly healthier.
But let's talk about more than just foot traffic. If you dig deep into their 10Q SEC filing, which is what we do here, you will find some serious exposure risks hidden right in the fine print. We are talking about severe trade-related duty exposures. They currently have a potential exposure of up to $56 million for anti-dumping and countervailing duties on imported aluminum pans, and another $53 million hanging over their heads for paper plates alone. For those unfamiliar, anti-dumping and countervailing duties are massive penalty tariffs slapped on goods that governments believe are being aggressively sold below fair market value. So we are talking about well over $100 million in potential tariff circumvention liability. Combine that with the rising general liability claims they openly admitted are driving up their operating expenses, and you have a recipe for sudden, unexpected cracks on the bottom line. This isn't just theoretical rust we're talking about, it's active corrosion threatening to eat directly into their future cash flows.
And here is another piece of temporary scaffolding that is slightly padding the numbers. Dollar Tree recently separated from the Family Dollar segment. Because of that massive corporate split, they recorded $21.1 million in transition services agreement income in Q1 alone. That is money they're making just for providing temporary back-end corporate services back to Family Dollar during the ongoing breakup phase. Now, we have to concede that point. That $21 million is completely transitionary. It's a one-off structural support that will eventually be removed from the standalone financials once the split is fully finalized. But to be fair, even if you strip that temporary scaffolding out completely, the core operational strength we looked at earlier remains entirely intact. Let's transition to Phase 5, Strategic Initiatives, the blueprint for growth. We need to look closely at management's long-term construction plans for actually sustaining this operation as a standalone banner.
This is the operational strategy they laid out following their recent Investor Day. Step 1, expand that multi-price offering. They converted or added about 630 stores to the multi-price format just this quarter alone, bringing the total to an impressive 5,900 locations. This frees them to optimize their assortment way beyond that strict $1.25 foundational constraint. Step 2 is aggressive expansion. They are targeting 400 new store openings in fiscal 2026 against only 75 planned closures. Steps 3 and 4 involve agile cost management and heavily modernizing their tech and supply chain. And frankly, they desperately need this. Historically, dollar stores have been plagued by severe supply chain inefficiencies, messy aisles, and massive distribution bottlenecks. Rolling out new distribution centers and modern warehouse management systems is exactly how you permanently fix those historic cracks. This is a blueprint that is actually built to scale.
But as we all know, blueprints mean absolutely nothing without the capital to actually pour the concrete. So look at this number. A massive $595 million. That is exactly how much Dollar Tree returned to shareholders through the repurchase of 5.5 million shares in Q1 alone. And the filings show they deployed an additional $98 million quarter to date right into Q2. Let's break down why that matters. When a company aggressively buys back its own stock, it shrinks the total number of shares on the open market. It's like having a pizza and suddenly cutting it into fewer slices. Every remaining slice of the pie instantly becomes much more valuable for the existing investors. And they aren't done. They still have $1.3 billion remaining under their board authorization, all backed by $1 billion in cash and cash equivalents, and absolutely zero commercial paper outstanding. That, my friends, is what I call an ironclad balance sheet.
And if you want undeniable proof of structural integrity, here it is right on the screen. Free cash flows surged from $129.7 million in Q1 of 2025 up to an astonishing $391.5 million in Q1 of 2026. Free cash flow is the ultimate bedrock metric. It is the actual, hard cash left over after paying all the operating expenses to keep the lights on and after paying for massive capital expenditures like building out those new physical stores. You literally cannot argue with that kind of cash generation. They generated $644 million in net cash from operating activities, absorbed $252 million in capital expenditures, and still walked away with nearly $400 million in pure free cash. That provides the ultimate balance sheet flexibility they need to aggressively execute all those new multi-price store conversions without taking on dangerous debt. Because of that ultimate financial flexibility, management is actively upgrading the entire blueprint. Their upgraded fiscal 2026 guidance projects net sales between $20.5 billion and $20.7 billion, holding steady on 3% to 4% comparable sales growth. But the real kicker here is the bottom line. They raised their adjusted EPS outlook to a highly profitable range of $6.70 to $7.10. For Q2 specifically, they are projecting $4.8 to $4.9 billion in sales and $1 to $1.15 in adjusted EPS. Management is clearly, undeniably confident that they have designed a financial structure capable of continuous top and bottom line expansion. But we have to remember, executive confidence isn't always economic reality. If the consumer drops off even slightly further in Q3 or Q4, they could easily miss these upgraded targets, and this entire reinforced structure could come crashing right back down to earth.
Which brings us to Section 6, the verdict. We've inspected the blueprints, we've tested the materials, and we've found the stress points. So is Dollar Tree an opportunity, or is it a trap?
Here is our final summary. On the structural strength side, you have an undeniable 120 basis point margin expansion, a massive surge to $391 million in pure free cash flow, and a ruthless share repurchase program, proving management's unshakable belief in their own asset. The multi-price conversion strategy is actually working, yielding a 4.5% higher average ticket, and doing all the heavy lifting for that massive EPS growth. But on the flip side, you absolutely cannot ignore the structural cracks we found during the inspection. A 1.0% decline in foot traffic proves they are bleeding actual physical customers in a remarkably tough economy. Combine that with well over $100 million in looming penalty, tariffs, and duty exposures for imported goods, and you have severe external pressures that could rust out those impressive margins completely overnight.
It is the ultimate test of strength. Management is loudly declaring that they are building Dollar Tree to last for decades to come, forging a significantly stronger portfolio for their investors. But as we all know, the broader market is utterly unforgiving right now.
So, we leave you with this provocative question to answer for your own portfolio. Can Dollar Tree's newly forged multi-price foundation actually withstand the crushing weight of a severe consumer slowdown? Or is it only a matter of time before this armor cracks entirely? Let us know what you think down in the comments. Thank you for joining this Iron Financial Explainer. Keep your portfolio structurally sound, cut through the market weakness, and we will see you on the next inspection.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.